I have watched men lose fortunes in a single afternoon and call it bad luck. I have watched others walk away from the same market richer and calmer than when they arrived and call it discipline. The difference between those two men was never intelligence. It was never even experience. It was the understanding of one ruthless and beautiful truth. The market is not random. It is not chaos dressed in numbers. It is a living creature with instincts, and chief among those instincts is this. It feeds on weakness, and it knows exactly where the weak hands are hiding. They call it the stop hunt. Professionals call it liquidity sweeping. I call it the oldest game in the market. And in 60 years of trading, from cotton to stocks to commodities, I never once encountered a market that did not play it. The question was never whether it would happen. The question was always the same. When it came for you, would you be the prey or the predator? Let me tell you something that cost me more than a few good years to learn. When you place a stop loss, you are not merely managing risk. You are leaving a map. You are drawing a line in the sand and whispering to the most powerful players in the room. Here is where I break. Here is where my conviction ends. And the men with the capital, the ones sitting behind the order books, the institutions and the insiders and the professionals who have done this longer than most traders have been alive, they read those maps. They have always read those maps. I did not understand this in my early days in the bucket shops of Boston. I was fast with numbers. I had instincts that other boys my age could not match, but I was placing stops like every other amateur, just below a round number, just under a recent swing low, exactly where the crowd had agreed the danger zone began. And every single time the market came for me. Every single time it dipped just far enough to take me out, then reversed and moved in the exact direction I had originally intended. I thought I was unlucky. I was not unlucky. I was predictable. Now, if you have not already watched our previous video on reading price action like a professional, I want you to go do that after this one. The link is on the channel. Understanding how institutional traders read the tape is the foundation of what I am about to tell you. Without that context, these concepts will feel abstract. With it, they will feel like someone finally handed you the key to a room you have been locked out of your entire trading life. The stop hunt begins with clusters. Everywhere the retail trader looks for safety, the professional sees opportunity. Below every significant low, there is a pool of buy-stop orders waiting to be triggered. Stop losses for those who are short, and pending buy orders from breakout traders who believe the price must first dip before it rises. Above every significant high, the same game plays out in reverse. These pools of orders are called liquidity, and liquidity is the currency the big players must have to move their own positions without destroying the price in the process. Think of it this way. If you are a fund managing hundreds of millions of dollars and you need to buy a large position in a stock, you cannot simply walk up to the market and buy. If you do, your own buying pressure will push the price against you before you are even half filled. You need sellers. You need a moment when retail traders panic and flood the market with their stop losses. You need, in short, a stop hunt. You engineer the price down toward that cluster of stops, trigger the cascade of selling, and there, in that manufactured panic, you accumulate your position at prices nobody else was brave enough to hold. This is not conspiracy. This is mechanics. This is simply how markets with a symmetric capital function. And once you see it, you cannot unsee it. The market is never wrong. Opinions are. Drop a comment below right now. Tell me, have you ever been stopped out, only to watch the market reverse immediately in your direction? Because I want to know how many of you have lived this lesson firsthand. Your comment may be the one that wakes up another trader in this community. So how does the stop hunt actually unfold, and more importantly, how do you begin to see it coming before it arrives? This is where most traders stop asking the right questions. They accept the stop hunt as something that happens to them like weather. Unpredictable, uncontrollable, simply a cost of doing business. They are wrong. The stop hunt is one of the most patterned and readable events in all of price action because it must follow a logic. It must go to where the orders are. And where the orders are is almost never a secret. You must begin to think in terms of liquidity pools. Every time you look at a chart, ask yourself not just where price has been, but where the resting orders are. A clean swing low that has been tested once and held is not a support level in the way a retail trader understands it. It is a magnet. It is a concentration of stops. Every trader who bought that level and is sitting with a position has their stop just below it. Every trader who is waiting to short believes that if price breaks that level, the move is confirmed. Both groups have orders sitting in the same place, and the professional knows exactly where that place is because they have the same charts you do. In our earlier video on institutional order flow, which I strongly encourage you to watch if you have not, it lives on this channel and will give you the vocabulary to understand what I am showing you now. We walked through how large players build positions in stages. The stop hunt is not separate from that process. It is often the final act before the reversal. It is the shakeout before the markup. It is the last manipulation before the trend resumes. There are three things I learned to look for before a stop hunt materialized. The first was a period of compression. Tight, sideways price action just above or below a significant level. When the market stops moving aggressively in either direction, it is often gathering itself. It is coiling. The professional is neither selling into panic nor buying into euphoria. They are waiting, and their waiting creates the compression you see on the chart. The second was a false break. Price would push decisively through the level, through the swing low, through the round number, through the previous week's range, enough to trigger the stops, enough to bring in the breakout traders, enough to create a brief moment of apparent confirmation. Retail traders would see that candle and believe the move was real. They would add shorts or exit longs. And then, sometimes in the same candle, sometimes within a few bars, the price would snap back. The wick would be left there on the chart like a scar, a record of who bled. The third was volume. Not always obvious, not always screaming at you, but if you trained your eye, you would see that the spike down into the stop cluster was accompanied by a surge in volume, the orders being filled, the stops being triggered, followed immediately by a drying up of selling pressure. When the volume disappears after the spike, it tells you the sellers are exhausted, the weak hands have been cleared, and into that vacuum the patient buyers step in and begin the real move. It was never my thinking that made the big money for me. It always was my sitting. Now I want to be direct with you about something. These patterns, this understanding, it does not matter how many videos you watch or charts you study if the psychology underneath your trading is broken. The stop hunt does not just destroy your account technically. It destroys you emotionally. Because being stopped out and then watching the market go where you thought it would go is one of the most demoralizing experiences in trading. It makes you second-guess your analysis. It makes you widen your stops so much that your risk management collapses. Or it makes you abandon your stops entirely, which is how accounts go to zero. This is precisely why I want you to look in the video description and get yourself a copy of the Livermore Journal, a 90-day trading psychology workbook. It was created to address the very crisis that the stop hunt creates in a trader's mind. 90 days of structured journaling, of pattern recognition, of building the kind of mental discipline that allows you to see a stop hunt for what it is, not a catastrophe, but information. It is available through the link below, and I want you to take it seriously. Not because it is a comfortable read, but because the market will not become easier to trade until you become harder to rattle. And alongside it, if you have not yet picked up Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk, the link is also in the description. I want you to understand that book is not a collection of trading tips. It is a framework for thinking. It is the difference between a trader who reacts and a trader who anticipates. Between a trader who is always surprised by the market and one who begins to feel its rhythms before they fully emerge. Leave a comment below this video and tell me which section of this script hit you the hardest. Your engagement helps this channel reach the traders who need this most, and I read far more of your comments than you might expect. Also, go take a look at the other videos on this channel. We have built a library that functions as a curriculum. Each video connects to the next, and the picture only becomes complete when you watch them in sequence. Now we arrive at the part that most trading educators skip, because it requires them to say something uncomfortable. Knowing the stop hunt exists is not enough. Understanding its mechanics is not enough. Even being able to identify it on a historical chart is not enough. Because when it is happening in real time, when your position is being squeezed, when the price is moving against you with conviction, when every instinct you have is screaming that you were wrong, the intellectual knowledge disappears. What remains is fear, and fear in the market is the most expensive emotion there is. I speak from experience that I did not earn cheaply. In 1907, in 1915, and 1929, across the great sweeps of my career, I was tested repeatedly not by my inability to read the market, but by my inability to remain composed within it. There were moments when I knew, with the clarity that only comes from years of study, that I was positioned correctly. And still, the pressure of a manufactured move against me broke my discipline before the market could reward my patience. The stop hunt did not just take my money in those moments, it took my conviction. And conviction, once lost, is the hardest thing to recover. So what is the solution? How does a trader protect themselves from an event that is specifically designed to exploit the most vulnerable human parts of their psychology? There are several answers, and I want to give them to you plainly. First, you must stop placing your stops where the crowd places theirs. This sounds obvious. It is not, because the crowd's stops are at the obvious places for a reason. They feel logical. Just below the swing low, just above the swing high, just outside the range. But obvious stops are liquidated stops. You must learn to place your invalidation point, the level at which your trading idea is genuinely wrong, rather than your panic point. These are different levels, and the difference between them is where the professional and the amateur are separated. Second, you must give the market room to hunt without hunting you. This means accepting that your position may experience drawdown before it moves in your direction. This is not comfortable. It requires confidence in your analysis and a position size that allows you to absorb the noise of a stop hunt without breaking. If your position is so large that any move against you feels catastrophic, you are trading scared, and scared traders are prey. Always. Third, and this is perhaps the most counterintuitive lesson I ever learned, you must begin to use the stop hunt as your entry trigger rather than your exit signal. When you see the hallmarks of a manufactured sweep, the compression, the false break, the volume spike into a key level followed by the immediate withdrawal of selling pressure, that is not a moment to run. For the predator, that is the moment of entry. That is when the professional steps in on the right side of the very move that just liquidated the retail trader. The stop hunt, properly understood, is one of the cleanest entry setups in all of price action. The weak hands have been flushed, the price has been artificially suppressed, and the move that follows is powered by the very liquidity that was just taken. We covered similar setups in depth in our video on institutional accumulation patterns. Another one I want you to find on this channel because what I am describing here connects directly to those concepts. The stop hunt is not an isolated phenomenon. It is one piece of a larger institutional process. And when you can see all the pieces together, the market stops feeling adversarial and begins to feel navigable. The big money was not in the individual fluctuations, but in the main movements. There is one final thing I want to leave you with, and it is not a pattern or a technique. It is a truth that took me a lifetime to earn, and I give it to you freely. The market will always be larger than you. It will always be older than your strategy, more patient than your discipline, and more sophisticated than your current level of understanding. Accepting this is not defeat. It is the beginning of real growth, because the trader who walks into the market believing they have finally figured it all out is always the most dangerous position away from ruin. But the trader who approaches the market with reverence, who understands that they are a student of something infinite, that trader develops the kind of humility that, paradoxically, makes them nearly impossible to shake. The stop hunt will come for you again. It has come for every trader who has ever sat in front of a screen and committed real money to a position. But after today, when it comes, you will not panic. You will not rage. You will not close your platform and walk away cursing your luck. You will look at that false break, that sudden spike into your level, that cascade of stops being triggered, and you will ask a single question. Is this the hunt, or is this the real move? And increasingly, with practice, with study, with the right tools and the right psychology, you will know the answer before the market gives it to you. That is the moment you stop being prey. That is the moment the market, which has taken so much from you, begins to hand something back. Not because you have conquered it, but because you have finally stopped fighting it on its terms and started reading it on yours. You are not here by accident. You found this video because some part of you already knows that the way you have been trading can be improved, and you are right. Every video on this channel is a step in that journey. Watch them in sequence, engage with the community in the comments, and do not sleep on the resources in the description below. Trade with patience. Trade with discipline. Trade like a predator.